Next, let us look at the quantitative parameters related to term loans. First one is technical feasibility. When business entities go for long-term project, they will fund the project with term loan and the balance portion they'll use their margin money. This is what generally happens in the industry. Okay. Here banks will be asking for project report to understand the viability of the project undertaken by customer. This project report may be prepared by in-house or it can also be prepared by firm of consultants or merchant bankers, right? Okay. Here the technical feasibility of the project and economic viability of the project is the foremost important requirement when it comes to funding long-term projects. Okay, so credit officer should satisfy himself that the projects, okay, for which the term loan they are proposing are technically, economically and commercially viable, and wherever required they can take a second opinion from bank's technical consultancy cell or from empaneled consultants of bank. Okay, this is the first aspect. The second aspect is promoters contribution. See, already I've mentioned that these projects cannot be funded only with the term loan. Okay, there should be some contribution from promoter. The satisfactory contribution from promoter is considered as 33% because that will give you project debt equity ratio of 2:1. However, depending upon the case and circumstances, banks may go up to, they come down up to 20% contribution level. It means 80% is going to come in the form of term loans. Okay, so there should be a definite contribution from promoters, but what should be the exact contribution level? What is the definite contribution level for promoters cannot be prescribed for all customers. It's going to be on case to case basis, and here sanctioning authorities will have discretion to decide that contribution level. The next aspect is debt service coverage ratio. This is the ratio which is going to measure how many times cash accruals will cover repayment obligations including interest. There is a benchmark ratio for DSCR. It is 1.75. It means cash accrual should be 1.75 times of total repayment obligations in a year. Okay. So we can divide this debt service coverage ratio into two. One is gross debt service coverage ratio. The other one is net debt service coverage ratio. The benchmark for gross debt service coverage ratio, already I mentioned, it is 1.75, whereas for net debt service coverage ratio it should be at least 2. Okay, right. The next aspect is margin on security. See, this is linked with promoters contribution as well, because I said 33% promoters contribution will give debt equity ratio of the project as 2:1. Here this 33% promoters contribution need not be entirely in the form of share capital. It can also be in the form of retained profits of business. It can also be in the form of unsecured loans brought in by promoters. Okay, but bank will try to keep this ratio as 2:1, and the level crossing 2:1 may require deviation approval and all. Okay, apart from above what we have discussed, there are other parameters. Okay, the parameters which govern working capital facility will also get applied to term loans to a certain extent, like for what purpose loan money is going to be used, what is the end use of funds, then what is the credit rating, what are the triggers for say reset of rate of interest, and so on.
Thank you for watching this video. Hope you liked it. If you wish to learn more on this topic, do check our comprehensive online course. I have given the link in the description below. If you like this video lecture, do not forget to click on that like, share and subscribe button with bell icon.